Hey everyone, welcome to this lesson. And in this lesson we are going to be looking at something known as the cost of capital. Okay, it's a new topic, and with this new topic we're going to be taking a different position, a different perspective in our enterprise, and we're going to look at all the financial concepts which fall under this cost of capital. And whilst we're looking at cost of capital, we're going to have to also look at the cost of equity, which is part of the cost of capital. So let's begin with the cost of capital. So to start off, it's best to understand and get a feel of what we're looking at, get a feel of what we're learning. And let's pretend that you and I are financial managers, okay? And as financial managers, what we do is we run a firm. We run a firm. Now, in order for a firm to generate profits, we need to take on projects. In order to take on projects, we need money. We need capital. And so where are we going to get this capital from? Well, let me just draw that. We need these things called capital, right? We need capital. Without fuel to run, how are we going to make our business work? So we need capital. So we next ask ourselves, hey, what do we need? Who can we get this capital from? And we get it in the form of equity, and thus shares, and also we can get capital in the form of debt. Alright, so debt holders and equity investors and whatnot. So now we know in what form we're going to get the capital from, and we know who we're going to get capital from, because we're going to get capital from people who are willing to offer equity, who are willing to offer debt. The next thing we have to realize is that, okay, the people who are going to give me capital, what do they want? Well, they require a return, don't they? These people aren't going to give us money for free. Furthermore, if our projects, if our returns are not above the risk-free rate, then what's the point of such people investing into our firm? There may be a point, but generally speaking, why would these people invest in our firm if they could just invest at the risk-free rate? And so they're going to require a return more or less larger than the risk-free rate. And if we have to give them a return, that means it's a cost to us. And this is what we refer to as the cost. This is what we refer to as the cost of capital. Okay, the cost of capital. That's what we refer to as the cost of capital. Hopefully that made sense to you all, and this is basically what we're going to be looking at these next few videos. We're going to be looking at the cost of capital of equity, because equity is part of capital, and we're also going to be looking at how we evaluate the cost of debt. Okay, now before I move on any further and henceforth look at the cost of equity, there's something important that we must remember, and one might think otherwise, but the cost of capital is primarily dependent upon the use of funds, not the source. Okay, not the source. So what do I mean by that? Well, once I have my capital, the cost of that capital is not going to depend upon who gave me the money, who gave me the capital. No, the cost of capital is going to be dependent upon how I use that capital. Okay? How I use it in risky projects. One might be like, hey, you got the capital from this person, thus it's that person who should more or less have a big impact, have a dependency upon your cost of capital. No, that's not true. Depends on how we use the funds. Sorry for this typo. So let's begin with the cost of equity. We're looking at the cost of equity because let's just think of our total capital. Our total capital is made up of equity and debt. And so to find the cost of total capital, we need to look at the cost of equity and the cost of debt. Okay? Oh, I've already done this here. So cost of capital can be split up into equity and debt. We're going to look at debt in our other videos, and in this lesson we'll be looking at equity. So I've drawn these two arrows to tell you that there are two approaches, there are two ways to evaluate the cost of equity. The first is the dividend growth model. And the second is the SML approach. Remember the SML from previous videos? Well, we're going to be using that. And in this particular lesson, we're going to be looking at the dividend growth model. Next lesson, we'll look at SML approach alongside with debt. So, before I begin with the dividend growth model and using it to evaluate the cost of equity, why don't we first look at a definition of the cost of equity. I've probably already stated it, but more formally, cost of equity is the return that investors holding shares in a firm require. Okay? If it's a return for them, it's going to be a cost for us. So, let's look at the first method of evaluating the cost of equity, or in other words, the return for investors. Well, we use this formula right here. You should be aware of this formula. We use it to find the price of a share. Okay, we use it to find the price of a share, and this should look familiar to you. And the numerator is equal to D1 because it's D0 times the growth rate, which gives us the price of the dividend in the next period. D1 all over RE. Now what's this R subscript E? That's the return on equity and furthermore our cost of capital minus the growth rate. And so making RE the subject, I can say that RE minus G is equal to D1 divided by P0. And this implies that RE is equal to D1 over P0 plus G. And there we have it. That right here is going to be our return on equity. So now we can do an example. Extremity prices shares at $40 per share. It paid a dividend of $3 last year, and it expects dividends to grow at 7% each year. Okay, each year. Now, what we want to do is calculate the cost of equity. Okay, fair enough. Pretty simple. Just have to use this formula and furthermore plug in 3 values. So RE is going to be equal to D1. Well, what's D1? I don't exactly have D1 explicitly, but I can find it because we know that D1 is equal to this, well, the numerator of this. And I know what D0 is. That's going to be 3 outside of 1 plus the growth rate, which is 7%, all over the price of the share. That was set to be $40. And I want to plus this by the growth rate. And plugging these values into our calculator. I get this, 0.15025 which can be said to be 15.03%. And so given this information, given how our shares have been being paid out, and our growth rates, and our dividends and whatnot, we can come up with a return that investors expect. Alright? And that's 15.03%. Now we have to ask ourselves, this is a cost, right? This is a cost to us. This is a cost to us. So when we undergo in projects, we want our return to be greater than this. Because if it's not greater than this, then we're going to be paying out all these costs to our equity holders, and it's going to be nothing for the business. Okay? And so that concludes, oh no, not right now, because I still want to talk about something. Let's look back at this formula. We have that RE is equal to this, right? And so I need three things. More or less D1 or D0, the price of the share, and G. D1 or D0 and the price of the share are relatively easy to find. But G, on the other hand, estimating G can be a bit more difficult. Why? Well, we'll have to estimate it using historical figures. What I mean is that, let's say I have years here, and here I have the magnitude or the value of each dividend in every year. What I've drawn here is I've calculated the growth, and that growth can be negative. I've looked at the growth between two periods. Okay, between here was 200%, between here was minus 37.5%, and between here was 40%. And what we do to estimate growth is that we get the growths of each, between each year, and then we calculate its average. Okay, so given these growth rates, and we want to estimate a G to use, well, we would just take the average. And let me just do this. And that gives me 67.5%, and thus I would be using this as a growth rate. So that's how we estimate G, and now I can say that we finish our lesson here.
Cut study time with concise video summaries by top students. Visit spoonfeedme.com to view more free videos in this course and hundreds of others.